Did Britain's factories down tools in May? Robert Wood joins me down the line to dissect the latest data feed from the UK. Rob, the 1.3% drop in May is baffling some economists. What did you make of it? What happened here?
This drop in manufacturing in May is just a blip. It is completely at odds with everything else we know about the economy. Surveys point to very, very strong manufacturing growth and manufacturing growth that has been improving for quite some months now. This is a blip that also seems to have been matched in some other Eurozone countries as well. In all likelihood, there will be a big bounce back next month and a return to the improving trend.
The data also showed Britain's economy kept growing at a robust rate, but the drop in investments is being described as a timely warning, indicating unless investment and net exports make bigger contributions to growth, the recovery could stall. Do you believe this is a real risk?
Well, investment and exports certainly need to make or continue making large contributions to British growth. Remember, in the first quarter, business investment rose 10% on the year, so that's certainly strong enough, but it does need to continue. Of course, when any data as important as manufacturing turn down, it's important to be wary of the risk that it is a sign of a change in trend, but I don't think this is one of those cases, because so many surveys of the manufacturing sector right now, of manufacturing sector sentiment and optimism, are so strong. I mean, some of them are touching near all-time highs. I don't think this is a particular point for worry for the UK.
Now, investors will be looking ahead to Thursday's meeting. The previous minute suggested a divergence of opinion within the committee, not to mention Carney subsequently being compared to an unreliable boyfriend. What is the market hoping for this time?
Well, the market's looking for no change this month. It will mark another no change in this long series of holding interest rates constant in the UK. That being said, the UK economy is growing rapidly now, even notwithstanding today's industrial production data. NISA, the research institute, estimate that output grew 0.9% in the second quarter, so another very strong increase. Unemployment is dropping very, very quickly, and some surveys suggest pay growth is beginning to pick up strongly now. So the time for a rate hike and the time to move interest rates away from their emergency low levels is approaching pretty quickly, we think, and I'm expecting the Bank of England to hike rates in November. I think the time for talk is nearly over and the time for action is approaching.
The pound is currently strong against the euro. Good news for holidaymakers, but not so much for businesses. Meanwhile, the US dollar was steady against a basket of currencies ahead of the Fed's minutes release tomorrow. How will the pound fare against these two amid the policy paths of their respective central banks?
Well, I think the outlook for sterling remains bullish. The Bank of England is very likely to be the first central bank to raise interest rates, and a lot of that has been priced into sterling, but nevertheless there is something different about when interest rates are actually raised rather than expected to be hiked. So I think that's a key driver of this. I expect the UK economy to continue performing strongly over the next few months and quarters too. So I think that is bullish for sterling. On the other side, you have a Fed that is remaining very dovish, and obviously an ECB that has recently cut interest rates further. So we have a Bank of England turning more hawkish, whilst Fed stays dovish and ECB cuts interest rates. So I think that's pretty bullish for sterling.
Rob, thank you. Well, that's all from Rob and myself for the moment, but keep informed with the latest currency movements by clicking back for our early updates. Goodbye for now.